Just because a stock is a loser, it doesn't start outperforming, and a stock which is a winner doesn't start underperforming. It takes time for these overreactions to come into the price and then reversals to start. The second point is that not all losers become winners and not all winners become losers. So they don't mean revert exactly. Richard Thaler and DeBond did a study on this. They took data of more than 50 years of the stock market. This paper was published in 1986. Their hypothesis or the question was, do markets overreact? And if they are overreacting, then these reversal patterns matter. So they took a study of stocks for 50 years before 1986. They classified each year companies into two buckets: a winner portfolio and a loser portfolio. Winner portfolio had 35 companies which were outperformers or the best performers of the last 3 years. And the loser portfolio was of the worst performing, underperformer 35 companies of the last 3 years. And they held this portfolio in simulation for 3 years. Now, if they were right, then these losers should outperform the winners in the next 3 years, subsequent 3 years. They found that the underperformers, the loser portfolio, is outperforming the winner portfolio quite handsomely. They repeated this test for 5 years and the results were similar. So they found out that this representativeness bias is leading to certain outperforming companies being termed as glamour stocks, or the companies to chase or be with. And people used to have fear of missing out if they didn't buy them. On the other side, there were these underperformers that people didn't want in their portfolio, were considered to be bad companies. They had become so cheap that they were vulnerable to any good news that comes in. So the price used to shoot up whenever some good news came in. So this study is very important in actually identifying how and when you actually pick up the underperformers.
But then, is somebody taking on too much risk by buying into losers or, the bad companies, as we call it?
So a lot of academics who actually like the efficient market hypothesis, they actually challenge this observation that you're buying losers, so you're taking more risk.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.